Another Friday, another scary tariff headline. Donald Trump is going to put reciprocal tariffs on many countries starting next week. Well, that's the big headline today that caused markets to fall 0.5% in one candle. That is a massive one candle reaction. Here in this video, I will share with you all of the news, data, and information you need to know, including non-farm payrolls today, Michigan consumer sentiment, where one-year inflation expectations actually skyrocketed, like something we have not seen in years. It's not as scary as you would think. Democrats are skewing the inflation expectations. I will share all of this and much more with you. Trust me, there's a lot in this video. And now Trump is coming out with some new headlines towards the end of the day. He says, quote, "We do want to work on the deficit, get it down to even." Trump says tariffs are an option to address the deficit, while he now says that he will announce reciprocal tariffs next week on many countries. Now, I will point out that as long as these tariffs are not on Canada, Mexico, China, or large tariffs on the EU, they're not going to matter as much. If Trump decides to tariff 50 smaller countries, it's not going to, make a huge difference. So that aspect could actually be seen as maybe positive to spread out the tariffs to other countries that may tariff us that are smaller in nature, that we don't do as much business with. So first and foremost, earnings last night across the board for some of your important companies like Amazon were not as good as expected. And we will start with this. Amazon, they raised their AI CapEx guidance to $100 billion for 2025. That is actually like good news for the AI story. That should give investors some confidence that AI growth will continue, while ELF dropped about 25% on a consumer slowing down, which kind of made me a little nervous last night. I'm not going to lie, for the jobs report coming out this morning, because if people are cutting back on $5 makeup products, then how can the jobs report show us something good? And in fact, the jobs report did come in on the low side today. I should mention last month was revised up from 256,000 to 307,000. Expectations this morning were for about 170,000 job ads. You came in at 143,000 job ads. So definitely came in on the low side. You missed estimates by about 27,000 jobs. That's kind of telling the Fed, like, hey, we should be thinking about cutting rates here pretty soon. The unemployment rate, although, fell from 4.1% down to 4%, but there's a lot of distortions on what causes the unemployment rate to go up and down. It's not really the best indication of the labor market at this point. Now, you had average hourly earnings that came in better than expected, up 0.5% versus expectations of 0.3%. Average hourly earnings year over year comes in at 4.1% versus 3.8%. Participation rate did tick upwards to 62.6% from 62.5%. Average weekly hours did fall from 34.3 to 34.1. Government payrolls came in at 32,000 versus estimates of 25,000. Manufacturing payrolls were positive at 3,000 versus expectations of negative 5,000. Now, believe it or not, the non-farm payrolls did not move markets the most today. What really moved markets was the Michigan consumer sentiment. So on the headline number, we came in at 67.8. Expectations were for about 72. So you came in really low on the headline number. But look at this. 5-year inflation expectations came in at 3.3%. That was in line with expectations. But 1-year inflation expectations skyrocketed from an expected 3.4% to 4.3%. I mean, this is the largest increase in 1-year inflation expectations in a very long time. Like, this looks like a hockey stick, okay? But when you actually dig into, the survey here, it's not nearly as scary as you would think. That is because when you actually look at the respondents of this survey, Democrats in green, you can see Democrats' 1-year inflation expectations went to 4.2%. And really, they're about 5.5% after this latest survey. So Democrats' expectations for inflation are surging, whereas that's really bringing up the median here to 4.3%. You can see that independents, which I think is really the best barometer, if you will, of inflation expectations, went up to 3.2 from 2.9. So really not bad at all. And then Republicans have plummeted down to 0.1. So Republicans expect no inflation, almost deflation. Independents expect 3.2% inflation over the next year. And Democrats expect 5.5% inflation. I mean, I think a lot of this has to do with media and tariffs and the news that tariffs were put on Canada and Mexico and they were delayed, and tariffs put on China. I think a lot of this just has to do with media headlines affecting people's sentiment, Democrats' sentiment within this survey. It's not an actual problem that we need to worry about. Now, it was also reported today that President Trump told Republican lawmakers he plans to issue reciprocal tariffs as early as Friday. It's kind of vague because we don't know who is going to be targeted with these tariffs. And since then, we have had a statement from the White House that they're not going to be discussing this today, right? That this could be discussed next week, but we kind of even got a vague answer from them. So a lot of people think this could be Europe, but we just don't know. And that is what did cause this big candle on the SPY, where you fell over 0.5% in just one candle. It was this tariff headline. But again, are we really shocked? This is the third Friday in a row that we have had this tariff news come out at the end of the day that causes markets to sell off. Okay, here's one Friday, here's another Friday, and now this Friday. Fed Goolsbee spoke today as well. He says the jobs report was strong. Labor market is settling into full employment. He's hopeful that tariffs won't hinder trade and comfortable with economy's path. Discount short-term inflation expectations spike, again saying it's really not something that's important. Notes the market sees the Fed hitting 2% inflation target. Expects the policy rate to fall significantly over the next 12 to 18 months. Goolsbee was also asked about some of the comments that Scott Bessent said over the past couple of days, where Scott Bessent has said, well, we're going to lower rates. And a lot of people were like, huh? You know, Trump said this a couple days ago, and people assumed that Trump would be bullying Powell into cutting rates. And well, Scott Bessent just came out yesterday, I believe, maybe 2 days ago, and said that they're really focused on driving down 10-year Treasury yields, not actually bullying the Fed into reducing rates. And I found it notable today that Fed Goolsbee said, quote, I agree with almost everything Scott Bessent has said about the economy and driving down long-run rates and deregulation. Fed Kashkari says the rise in 10-year yields could also be from fiscal deficits. I mean, that's a genius observation, because we all know that. I mean, the Fed is finally starting to understand that the fiscal deficit picture is what caused 10-year Treasury yields to rise recently. Well, my argument that I've made in recent days to you guys on this channel is that things like Doge and reducing or set to reduce the deficit are actually causing bond yields to fall in recent days. Okay, besides today, 10-year Treasury yields are up about 5.5 basis points. But ever since January 10th, January 13th, right before the inauguration, as Doge was set to begin their cost-cutting operations, you have seen 10-year Treasury yields pretty much fall every week since. I mean, you've fallen from 4.8% to 4.5%. 4.49% today. If you're rounding up, you'd round up to 4.5%. That's a 30 basis point drop in 10-year treasury yields. And I think it has to do with Doge cutting government spending and a more fiscally responsible outlook for the federal government. Okay, this will be very positive for stocks, especially if you continue to see 10-year treasury yields fall, as I believe you will. That's going to be a tailwind for markets. And Trump has signed an order amending duties on de minimis imports from China. So some companies look like they will be exempted from the China tariffs. Goolsbee also said today, I think it will take longer than the end of 2025 to get to a neutral policy rate. Ed Kashkari says the Fed will get inflation back down. And again, not to skip over the rest of the Michigan Consumer Sentiment Survey, you did have consumer expectations that came down to 67.3 versus an expectation of 70, and current conditions that kind of plummeted from 74 last month to 68.7 versus expectations of 73. So current conditions came down, consumer expectations came down, 5-year inflation expectations remained steady, but 1-year inflation expectations rose because of that skew from Democratic respondents in the survey. So really, this was pretty good data today from the Fed's perspective, the inflation fight perspective. And short-term U.S. interest rate futures add to losses today. Traders now betting on just one Fed rate cut this year. And I think a lot of that has to do with the unemployment rate actually falling from 4.1% to 4%. And a senior administration official to Trump says the Trump administration is committed to complete denuclearization of North Korea. And the White House says that the jobs data today underscores the necessity of President Trump's pro-growth policies, which obviously is true, but some people would argue laying off a bunch of employees, 40,000 plus government workers, is probably not going to be a good thing for the labor market. But you can also argue there's a lot of positives with cutting government spending and reducing waste. And Trump orders states to halt EV charging programs. Mark Newton, Fundstrat's chief technical strategist, says on X, it's funny that most financial news media are all saying today's sell-off is due to, quote, tariff uncertainty, when much is still unknown and markets have largely been resilient through all this fear. Today's upbeat jobs report ahead of next week's huge supply would be a more accurate answer, or that technically SPX and QQQ had reached the highs of their recent range and some backing and filling was expected. Food for thought. Always question the accuracy of those within the media who try to pin market movement on the latest narrative of the week. And I actually think he's wrong in this. I think markets today are moving lower because of the tariff uncertainty that was announced from the White House. I mean, there was a 0.5% red candle on the SPY when that news came out. But I would agree that next week may have little to do with the sell-off that we're seeing today or some of the tariff uncertainties, as long as the situation does not progressively get worse. David Rosenberg says the harsh math behind the jobs data, if you weigh in both the bodies and hours, it's as though payrolls fell 230,000 in January after a 120,000 contraction in December. The built-in for Q1 aggregate hours worked is negative 0.7% on an annual rate, which means that productivity will have to do all the heavy lifting to prevent a negative reading for the current quarter real GDP growth. And apparently the 442,000 jobs allegedly created in Q2 will be revised down to negative, according to the Philadelphia Fed. And look at that, ladies and gentlemen, the EU to offer lower tariffs on US cars. It does look like we were correct in our initial assessments that Europe was likely the area that was going to be tariffed next or have those tariff threats, and they are already starting to make concessions for the US, which hopefully turns out something like Mexico and Canada, where we just get slightly better trade deals and there's no actual tariffs that come from this. From a market's perspective, that is. And also in the news today, Japan's Ishiba says we are ready to further our investments in the US, and specifically is noting Toyota, that says Toyota wants to invest more in the US as well. Now, with all of this said, CNN's Fear and Greed Index today is in fear at 41, which is pretty much unchanged from yesterday. Markets are just in a very fearful place, and it is what it is until we get some of these tariff headlines out the way, until we get more certainty. Markets are going to be fearful. That's the new normal for now. Market momentum is fear, stock price strength, extreme fear, stock price breadth, fear, put and call options, fear, market volatility is neutral, safe haven demand is neutral, junk bond demand is currently in greed. The percent of stocks trading above their 50-day moving average also down big today. 4.32% of stocks are falling below their 50-day moving average. This is a big reversal from the last couple of days where you have been in that 53% range or so. So big downward action here today. And well, yeah, that's going to happen when you have uncertainty and volatility and, well, uncertainty even around earnings season. You're seeing a lot of companies coming out and giving some pretty piss poor guidance, like Elf. I mean, look at that stock down 25% in overnight trading last night. Overall, down to 47.22% of stocks trading above their 50-day moving average. For anyone bearish on our markets, remember, this is usually not the peak of a market when half of stocks are trading below their 50-day moving average. That just sounds insane to say out loud, given where the SPY is on a headline level. Now, as I also shared with you yesterday, you are now at a one-year bearish high for sentiment in markets. We had a yen flash crash trade, 10% correction, 7% correction in the past year, and you are more bearish now than any of those other moments in the past year. I mean, Nvidia fell 17% like a week and a half ago, and you're more bearish today than you were then when the whole AI trade was up in the air. That is crazy to me. 42.9% of investors expect the stock market to be lower over the next 6 months. 23.8% expect it to be flat or unchanged, and 33.3% are bullish, expecting stocks to move higher in the next 6 months. Now, Fed Kugler says it makes sense to hold the policy rate where it is. Donald Trump says auto tariffs are on the table, and he says DeepSeek is a good development. And Donald Trump says he expects to talk to Zelensky next week, wants to discuss security of their assets like rare earths. Trump says he is in no rush on Gaza, and he will be talking to Putin and probably China's president as well next week. Now, for the S&P, again, as I said previously, I have not seen a technical, trading pattern like this on the SPY in, I think, ever. I mean, you're going up 5 days or 4 days, you're falling on the 5th day. You're gapping down on Monday, you're going up 4 days, falling on Friday, gapping down on Monday. You go up 4 days in a row like we just did. Well, technically not 4 days in a row, but you normally see a recovery from the gap down on Monday. And that's what happened this week as well. And then you head into Friday, and today, down over 0.5%. Do we gap down Monday and then trade higher into next week again? I do not know. But from a technical perspective, I do want to point out some bullish and bearish things going on. Number one, you're creating this pretty obvious downtrending line of resistance here. If you break this to the upside, that's going to be a positive, and I want to extend it out a little bit. You break that to the upside, that's positive. That's going to give you a break to a new level. Okay, if you start to come down and trade lower, then you could be targeting that 590, 591 level as soon as next week. And I think these are really the levels you want to watch for at this point. And it's so methodical the last 3 weeks. It's kind of been like the same routine for 3 weeks in a row. It's kind of crazy to see here on the charts. If you guys have a better technical take than this, let me know down below in the comment section. But another big level to watch for is this 20-day moving average. at least this week, that is. You found a lot of support at this 20-day moving average, as well as the 50-day moving average at 597. You should find support at these moving averages, which could theoretically give us downside from here, about a 0.5% to the 20-day moving average, and about 0.75% lower to get to that 50-day moving average. So still could be some downside. Maybe that's what's in store for us coming on Monday, and then we'll see if we start to, trade upwards again. But clearly making a set of, higher lows and, lower highs, which in and of itself does not look great or does not sound great. That's typically a very bearish pattern. But the setup that we do have, we're closer than not to this upside resistance. And if we can break that, then you could see a larger breakout to the upside. But I'm not here to draw any conclusions, just point out what's going on. And again, 10-year Treasury yields, as we have made a lot of progress in the last couple of weeks, they are up about 6.5 basis points today. I really don't think they should be. 1-year inflation expectations really are not accurate. And the jobs report was not nearly as good as it might look like. You missed on the headline numbers, unemployment rate fell. Because the participation rate went up a little bit and because there's been less immigration. But, I don't think this should be driving up 10-year Treasury yields. So odds are good that we can reverse some of this coming next week. So let me know what you think about all of this information down below in the comment section. Ladies and gentlemen, have a fantastic rest of your day and weekends. I will see you in the next one.